Hi, my name's Alex. I'm an independent financial advisor. In this video, we're going to look at what the teacher's pension is, how it works, how it's calculated, and other little known facts about it that you might not be aware of. At a very, very high level, the teacher's pension scheme is based on your length of service and your earnings. It's known as an unfunded pension scheme, which essentially means there isn't a pot of money that you need to worry about or manage. The payment of your pension is paid for from the government and specifically the Treasury. Although it's unfunded and effectively paid by the government, you will still contribute towards it, and you're going to see a deduction taken from your payslip each month, and you can see what the contribution levels on the screen are now. The pension will be paid as an income when you retire each year until you die, and there can also be a tax-free lump sum component, which we're going to explore in more detail later on. To make things more confusing, there are 3 different schemes associated with the teacher's pension that you need to be aware of. How much you get, what's going to depend on which scheme you belong to, and it's possible to belong to more than one scheme. So why are there 3 of them? Well, this is because the government has been tinkering with the teacher's pension and indeed other public sector pensions. We have 2 final salary schemes, the first of which is a normal pension age of 60, and anyone who joined the final salary scheme before January 27 will belong to this one. The second final salary pension scheme has a normal pension age of 65 and is for anyone who joined the final salary scheme after January 2007. The reason for the 2 different final salary schemes is because, as the name would suggest, the normal pension age changed, and indeed the accrual rate did as well for the pension scheme after 2007. If the accrual rate sounds totally foreign to you at this stage, please bear with me. I'll get to it later on and hopefully explain it clearly. The third scheme is referred to as the 2015 scheme, as this reflected the changes to the teacher's pension and other public sector pensions as they moved away from being based on final salary and became based on your career average revalued earnings. There are some very important differences between the 3 of them, so to try and explain how much you get, it's going to depend on which scheme you belong to. So for anyone who joined the teacher's pension scheme after April 22, feel free to jump to the career average sector, as anyone still an active member is accruing benefits in the career average scheme now. Starting with the final salary scheme with a normal pension age of 60, anyone who was enrolled into the teacher's pension before 2007 will have accrued benefits in this scheme. So the normal pension age, as we've said, is age 60. This means you can take your pension benefits from this age without penalty. You can still take your pension from 55, but if you do so, there can be a penalty and actuarial reduction for doing so. Although the name for the final salary scheme would suggest it's based on your final salary, it's not strictly correct. This is because it's based on your average salary, which is the higher of either the average of your best consecutive salary for 3 years in the last 10 years of your service, or just your pensionable salary in the previous 12 months. This basically protects you against a scenario in which maybe your salary dropped in the last year for one reason or another, and you ended up with significantly lower pension benefits. How do you build up benefits in this particular scheme? Well, it's based on 1/80th of your average salary for each year of service that you have. Let's put this in layman's terms. So say Sally has 20 years of pensionable service and her average salary was 35k during that time. This would give her a pension of £8,750 a year, or for the more numerical of you, works out at a quarter of her salary. The annual pension, it's not just a static amount, it's going to increase by inflation as measured by the Consumer Price Index, so that hopefully your pension keeps up with the price of inflation and the cost of living, etc. In addition to the annual pension, you're also going to be entitled to an automatic tax-free lump sum. Your entitlement is based on 3/80ths of your final salary, your average salary. Put a simpler way, this is 3 times the annual pension, so in Sally's case, this would be a lump sum of over £26,000. However, to make things more confusing, you can take more tax-free cash at the expense of reducing your annual pension. To work out what the maximum additional tax-free cash you can take is, you take the annual pension, multiply this by 30 and divide by 14. Take Sally's case, this means the maximum additional tax-free cash you can take on top of the automatic tax-free lump sum that you get would be £20,625. However, there's no such thing as a free lunch. For every £12 tax-free additional cash she takes, this would reduce her pension income down by £1. In other words, if she took the maximum amount of additional tax-free cash, that £20,625, this would reduce her income by £1,718 per year. Okay, so if you join the final salary scheme after 2007, then you will accrue benefits in this scheme. It's similar to the normal pension age 60 scheme in that your salary is again based on the same rules, so the average of the 3 best years in the last 10 years or just your salary from the previous 12 months. However, there are some subtle differences. The first of which is that the normal pension age is 65, as the name would suggest. So you can again still take the benefits from 55, but your pension benefits will again be actuarially reduced for doing so before the normal pension age. The amount your pension benefits will be reduced by is approximately, this is just a rough and ready amount, is 4% a year. So the normal pension age is very important, and the higher normal pension age is generally worse if you plan on retiring earlier. Let's say you retire at 55 from this scheme. This is 10 years before the normal pension age of 65, whereas for the other scheme, which has a normal pension age of 60, retiring at 55 would only be 5 years of penalty rather than the 10 years. Another difference is in the accrual rate. The accrual rate is faster at 1/60th of your pensionable salary, which means that for each year of service, you get 1/60th of your average salary as a pension. So let's say John has 10 qualifying years of service and his final salary is £30,000. He'd be entitled to a pension of 5k per year. Unlike the previous scheme, however, there's no automatic standalone tax-free cash component. To calculate the maximum amount of lump sum that he can take, there's a slight variation in the formula. It's your annual pension multiplied by 30 and divided by 7. Take John's example from earlier, the 5k pension. This means the maximum amount of tax-free cash that he could take is £21,428. The same rules apply around commutation, which is that for every £12 of tax-free cash that you take, you lose £1 of income. This means if John took the maximum amount of tax-free cash of £21,428, this would reduce his pension income to £3,214 a year. In 2015, there were 2 notable changes made to the teacher's pension and all other public sector pensions. The first of which is that future accrual would now be based on your career average earnings. The second of which is that the normal pension age of the scheme would be linked to your state pension age. For anyone born after April 78, this will be a normal pension age of 68. If further changes are made to the state pension age in the future, say for example the state pension age rose to 70, then this would become your teacher's pension normal pension age, normal retirement age. As it's often called the 2015 scheme, logic would make you think that any benefits accrued since 2015 will be based on your career average earnings. Well, this isn't correct, and one of the reasons for this is because of the McCloud Judgement. I don't want to get into this too much for the sake of brevity, but essentially, if you have transitional protection, then all service between April 15 and March 22 has been rolled back to the final salary scheme, and you'll accrued benefits under the final salary rules. When you come to take your benefits, though, you'll have either option to take the accrued benefits from this remedy period on either the final salary scheme or on a career average basis. In terms of what's best for you, the teacher's pension is a handy calculator which you can use to see which suits your circumstances. Importantly, if you're still in service after April 22, even if you were originally in either of the final salary pension schemes, then you'll be now accruing benefits from this date onwards in the career average scheme. So how does accrual work in the career average scheme? Well, members bank 1/57th of their pensionable earnings for each year of service. The amount banked after a successful year increases by a revaluation factor. For active members, so those still in teaching, the banked amount increases by CPI plus 1.6%. If you're a deferred member, maybe you've left teaching but haven't taken your pension, well, the banked amount will still increase but only by CPI. Let's see an example. Deborah, she joined the scheme and in her first year, her earnings were 35k. The career average pension she built up is therefore 35k times 1/57th, which equals £614. In the second year, her salary increased to 38k. Well, what pension she built up then? So for the second year, we take 38k and multiply this by 1/57th again to give her an annual pension of £666. Is her accrued pension simply £1,280 a year? No, we need to increase the first year banked amount by CPI plus 1.6%. Let's make an assumption and assume inflation in that first year was 3%. So we take 614 and multiply this by 4.6% to give us £642 and add this to the most recent year of accrued pension, which will give Deborah a pension of £1,308 a year. The reality is that a lot of teachers out there are going to have accrued benefits in both sets of schemes. What happens then if you've got two of the pension schemes perhaps? How do they interact? It's also worth highlighting that the final salary pension is based on your salary when you exit teaching, not your salary when you just join the career average scheme. If you take your final salary scheme benefits at the normal retirement age, which is going to be either 60 or 65 depending on which scheme you belong to within the final salary scheme, then you can leave your career average benefits and take them at a later date. However, this is very important, if you take your final salary pension benefits before the normal pension age, say you take them at 57, then you must take your career average benefits as well. If you remember, the normal pension age of the career average scheme is linked to the state pension age. So say your state pension age is 67 and you retire at 57 and you take your final salary benefits. This means you must also take your career average benefits, and as this is 10 years before the normal pension age, 67 minus 57, early retirement penalties could see your career average benefits reduced by a whopping, call it 40% or so. The normal pension age for the respective schemes is 60, 65 and now linked to your state pension age for the career average scheme. Remember, you can still take the benefits from 55, but if you do, the pension may be actuarially reduced. This is because the scheme has an obligation to pay the pension for longer as you are taking it younger. In terms of how much it will be reduced by, well, this will vary across the different schemes as they apply different early retirement factors. If we take the final salary normal pension age 60 scheme as an example, if you retired at age 55, a factor of 0.811 would be applied to your benefits, which, if you just reverse this factor, would mean your benefits will be reduced by, let's round up and call it 20%. However, if you are made redundant by your employer and they agree to something called premature retirement, then you can take your pension early and without penalty. Don't forget that if you have both final salary benefits and career average benefits, well, if you retire before the normal pension age, then you must also take your career average pension at the same time, which means you could incur quite significant and serious early retirement penalties. What you're going to get will depend on when you die. Generally, there are three different scenarios if you died in service as an active member of the scheme. Secondly, if you died whilst maybe in payment, so you're in receipt of your pension. And finally, if you're a deferred member, which means you've maybe left teaching, but you haven't quite yet taken your teacher's pension. It's possible to nominate someone to receive a lump sum tax-free payment, which is referred to as a death grant. An annual pension may also be available, and exactly who this will go towards will depend on your circumstances. A survivor's pension can be payable to the likes of your spouse, civil partner, qualifying partner if you aren't married, and even children in certain circumstances. If you die once the teacher's pension is in payment, for the career average pension benefits, a survivor's pension could be paid at 37.5% of the pension that was payable at your date of death. So let's say when Terry died, his teacher's pension was worth 10k a year. In that case, his wife, Sheila, could be entitled to a pension of £3,750 a year. If you had accrued any final salary pension benefits, well, a survivor pension could again be paid, and this would be at 1/160th of your final salary for each year of pensionable service. If you die within 5 years of collecting your pension, then the full pension amount will be paid for 5 years, less any payments that you've received at the full amount. What happens if you die in service whilst you're potentially still teaching, perhaps? Well, a death grant equivalent to 3 times your salary at the date of death could be paid. Let's say Mark died in service, his salary was 40k. Well, a death grant of £120,000 could be paid to his nominated beneficiary. A survivor pension may also be available. If you're in the career scheme, this will be again equivalent to 37.5% of the accrued pension at the time of death. If you're in the final salary scheme, the dependent pension will be based on that 160th for each year of pensionable service and based on your average salary. If you're wondering if the teacher's pension is enough to retire, watch this video which looks at how much you may need to retire and if you can afford to retire early.